Hi, everyone. Thank you for joining us today at the Maine Small Business Development Center for the very first 2021 webinar. So we're getting the year started right. We are consistently doing these about once or twice a week. Each month, we're putting out a calendar of all the events that we are doing, and in each follow-up email after a webinar, you'll get a list of all of the scheduled upcoming classes. So definitely keep an eye on that calendar as it continues. Today, we will be joined by business advisor and center director, Raynor Large, comes from AvCog. He'll be going over what goes into buying a business. So maybe starting a business from scratch isn't exactly what you want to do. Established businesses are a great way to get your foot in the door. So he'll be going over all the information you might need right now, or perhaps in a future endeavor, whatever. These things tend to happen quicker than you imagine. And I'm sure he'll be going over all of that. So you will also get a follow-up email from me after this that will include a recording, including the slides. So if you feel like there's anything that you missed or wanted to rewind to, all of that will come to you in an email with Raynor's contact information as well. And I'm sure that there will be time for questions at the end, but in the meantime, feel free to introduce yourself in the chat and submit any questions you have along the way there. And we will circle back to anything that doesn't get covered towards the end. So I will pass the mic over to Raynor.
Thank you, Kelsey. Yeah, so my name is Raynor. I'm a center director here with the SBDC. I'm based out of AvCog. Bit of background, the SBDC has about, I think we're up to 18 advisors throughout the state of Maine. Our primary work is done one-on-one. We like these webinars, but our favorite thing to do is meet with you one-on-one. We are state, federally, and locally funded, which means we're a free service to you. So if I cover anything, and we're going to be covering a lot of information today, that you have additional questions on, or you want to follow up about a particular opportunity that you have, please reach out to us directly. Bit of background about myself. I've been with the SBDC about 2 years. Prior to that, I worked as a financial analyst for a turnaround firm. I also work as a financial analyst currently for the largest listing business brokerage in the state of Maine. To this point, I've done a little over 100 opinions of value or valuations of businesses. I've represented both buyers and sellers at the brokerage table. So this is something that I do have some familiarity with, and more than happy to kind of share that with you. As we go through this today, a copy of the slideshow and a recording will be made available to you, but like I said, we do prefer to have that one-on-one, so feel free to reach out. My contact information will be available, and you can register for advising right with the SBDC at www.mainesbdc.org. We have quite a few people online today, so we will mute your connections just to make sure we can get through this clearly. I will stay on as long as possible at the end to answer any questions you have. And if you want to drop questions in the chat as we go, I'll try to keep an eye on that. What we're going to cover today. So we're going to kind of cover from the start to the finish of the buying a business process. So kind of talk a little bit about why buy, try to identify what exactly you would be buying, how you'd buy it, what it's worth, some identifications of value, structuring a deal, and then some next steps, best practices, due diligence, just some things I'll leave you with. So why buy is always the first question, right? So I won't spend too much time with this. I understand if you've signed up for this webinar and you're taking your afternoon to listen to me talk, you've probably already given it some thought. Might just be tired of working for others. You might want to kind of keep what you kill and have that hard work that you're putting into wherever you work now be really sweat equity, right? That you're building up with some bonus on the back end. If those two thoughts appeal to you, but you're hesitant about starting a business from scratch, that makes sense, right? You don't want to recreate the wheel. An existing business often has a confirmed market presence. There are a lot fewer assumptions you have to deal with. You have an existing customer list. You might have employees in place already. So there's a lot of benefits that come from buying an existing business. One of the things that we're going to spend a lot of time on is kind of identifying the structure and the deal and the price. So it'll be what happens after you've identified the specific business that you have in mind, right? And for you, where to start is really identifying what your relationship is with the seller. Like any negotiation, like any purchase, there has to be an agreement between two people, right? You can't unilaterally buy a business. You have to have a ready, willing, and able seller and a purchase price that can be achieved by yourself, a commercial financer, or the seller working together. So that negotiation, that relationship is critically important, both in the transaction and often surviving the close, which we'll get to as well. So identifying your relationship with the seller, whether or not you're staff or a family looking to buy out an existing owner, or you're looking to buy an owner-operator position, in both of those, you're really buying yourself a job, right? And what I mean by that is you're going to buy a business that already exists, and you're going to plug yourself in where the owner is currently. And ideally work 40, 50, 60, 80 hours a week as the owner of that business. So you are buying yourself the job security of owning the business that you work for. Now there's this other option, which I'll touch on quickly, but we won't spend much time with, is the synergistic buyer, right? So if you have an existing business and you're looking to buy a book of business elsewhere, what you're really buying is a market share. Right? You already have a job, you're just expanding that job elsewhere. Looking at the participants we've had, I'd say about 80% of you do not have a business currently. So you're truly a startup buyer. So my focus is going to be on those first two slots where you're either in the business already or you're looking to buy yourself a job. Now, in both of those cases, this question of how you will pay for it becomes critically important, right? So you'll use some combination of personal equity or a commercial loan or a seller note, but you'll have to pay that back or justify it through the cash flow of the business, which becomes very important when identifying a purchase price. There's some advantages and disadvantages, but that part that I've bolded, that paid for by the cash flow of business, is really what you're buying, right? So when you're looking at buying a business, you're buying the physical assets, and you're also buying goodwill, right? That's the catch-all term a lot of people use for the website, the customer list, the reputation, right? The idea that the business has existed. But the important thing here, when you're a buyer identifying what you're buying, is that you're buying the ability of the physical assets to demonstrably generate cash flow in a reasonable time frame. There's a couple parts to this that I want to break down, right? So the idea that there is a goodwill value unsubstantiated by cash flow is false. Right? It's unfortunate because a lot of people put blood, sweat, and tears into a business. I've had the best example I have is a seller coming and saying, well, what's the business worth? Oh, 2 heart attacks and a divorce, right? It's what I've put into the business. Now, as a seller, that might be what it's worth to you. But again, going back to that negotiation, you have to have a buyer, and you as a buyer have to be able to justify that price. And if those assets that exist are not generating substantial cash flow, then there's no demonstration of value in those intangible assets, whether or not we want there to be, right? It's a very difficult conversation to have. But if I have a bunch of random assets in my backyard, that's not a business. I can make a website. I can, I have a list of people who could potentially buy those things. But at the end of the day, unless those things are working together and there's an existing systems, policies, procedures in place that create cash flow above and beyond just the physical assets, there is no goodwill value. So, the demonstrably generate is important as well, right? So if you sit down with a seller and they say, well, I don't like paying taxes, so I just pocket half the cash that comes into my business. Well, that's all well and good, but are you willing to pay for that? On a wink and a handshake. It's kind of a pay now or pay later, right? If they haven't paid their taxes, they have no demonstration of that cash flow. So it becomes a very tenuous and difficult negotiation. Whether or not you as a buyer are willing to pay for it, a commercial lender often won't lend to it. And hopefully you have a team around you to protect you from decisions like that with an attorney or an accountant saying, hey, you know, I'm going to wave a flag here. This might be a risk. And then a reasonable time frame is also very important. Right? So if I'm selling you some assets, I'm calling that my business. Any business is worth $1 million if you take, 20 years to pay me back, 30 years. But what kind of return on investment is that for you as a buyer? So being able to say, okay, here's the cash flow generated by these assets, and the assets are working together. And what I'm really buying as a buyer is, yes, those assets, but all of the work those sellers put in to get those assets to work together, right? To make something of them above and beyond just a couple pieces of equipment. And can that generate my return on investment that I need? So one of the things we're going to talk about and spend some time with is really reviewing tax returns. And I start with tax returns because internal financials are good, right? A lot of the time there's more detail in the internal financials than just on the tax returns. But the tax returns have an accountant's stamp of approval and they've been submitted, right? So someone somewhere is liable for those tax returns. They've at least had that level of oversight, right? Even if it's the owner submitting them themselves, the owner has said, okay, I'm comfortable with submitting these financials to the federal government and I stand behind them. So there's that level of oversight. Right? So some things we'll look at that I recommend is taking several years of tax returns from the due diligence process and comparing them year to year, right? And what you're looking for is continuity and trends, large jumps in accounts. Is there a large miscellaneous account or other? What are the question marks, right? And a lot of the strength of a business, that kind of systems in place, is reflected in the financials, right? If the financials are everywhere and there's no certainty, and some things were office supplies one year and another year, and miscellaneous the third year, and the owner doesn't know, that's a red flag, right? You're saying, okay, if you can't explain these things, well, then what am I buying? What are the systems in place if they don't do enough to at least show the business as a cash flow producing business? And then, the other benefit of the tax return is that it's the income statement. So if you're buying a business, right, you're buying the income statement, which is the assets creating cash for the business. And to a degree, you're buying the balance sheet. Now, a balance sheet is the list of assets and liabilities. But if you're buying a business, the assets are whatever you're paying for, right? The physical assets and the goodwill. And the liabilities are however you're paying for them, right? It's the commercial loan, the seller note, and then you have the equity piece, which is your down payment. So you're creating the balance sheet on day one with the purchase, right? The purchase structure creates a new balance sheet. So you're not really as worried about that as the income statement, the tax return, which is showing you, okay, what is the business doing with the assets it has? Is it generating enough revenue? So when you're identifying cash flow, right, there's two major terms that get thrown around a lot. The first is called EBITDA, right? And the other is seller's discretionary earnings. And I have a little graph here to kind of show the two. So EBITDA is used by commercial lenders, and it's equity before interest, taxes, depreciation, and amortization. And all this is saying, right, really, what it boils down to is what is the cash being generated by the business? And so you have your net income, which is the bottom line of the business, and then you add some things back. Right? So you add back depreciation and amortization, which are, it's a tax strategy, more or less. They're non-cash though, which is important. Right? So you add them back because they're not actually a cash thing. It's just a way to diminish your tax burden. Then you add back your taxes, obviously, and you add back your interests, because for you as a buyer, your interest is going to be different than the seller's historic interest, because your debt structure is going to be different than the seller's. Right? So that gets you to EBITDA. Now, as a buyer and a seller, there are some other things you can do, right, with your business to reduce taxes. And I'm not here to pass any judgments or do any, how taxes are handled are entirely up to you and your accountant. But, as a business owner, you might not want to pay as much in taxes. So you might have your cell phone plan, right? You might have a 401k. You might have other kind of ancillary expenses on your tax return that are legal, right, and verifiable. This is nothing below the table. This is just ways to expense things, an automobile, vehicle. For the business, you can expense it. But they're ancillary, right? They're not critical to the business itself. And that's important because as a buyer, you're saying, okay, I might want to spend that money a little differently, right? Where you had a vehicle, I might call it education, and I'm going to get my MBA and have my business pay for it. That's fine, right? That's part of the business. But we want to add those things back, or at least account for them. Or a business owner might be taking out $120,000 a year in salary. And you're saying, geez, I can live off of $80,000 a year. So that gives me a little bit more of a buffer. Or you're saying, I really need $150,000 a year to make this work. So SDE, the seller's discretionary earnings, starts with EBITDA and takes it another step. It says, okay, well, what about this discretionary earning piece? And what about the owner's salary, seller's salary? Because what they're selling is what you're buying, right? So that cash flow, historically, you can look at, you can get the tax return, you can work through it, and you can say, okay, here's what is being generated by the business. What I'm buying as a buyer in this case is that cash flow. I'm buying that cash flow. That's worth something to me. What is it worth? So that's where your perspective comes in. So what you're buying, what is being sold, is the ability to support debt, right? And your salary needs. So you add back those things historically from the tax return, and then you look at it and you say, okay, if I have $50,000, $100,000, $500,000, what can I do with that? So you have your own salary needs. So you have to account for that, right? As a buyer, you say, okay, here's my mortgage, here's my monthly car payment, here's what I need for food and clothes, here's what I want to put into my retirement account. You have your expectations as a buyer. Here's what I want to pay for myself. Then you have the ability to support debt, which is really two parts, right? So a debt coverage ratio is what a bank looks at and says, okay, if it's $150,000 and you need $50,000 for personal salary, we're not going to lend you debt that requires $100,000 to pay every year, right? You're a hiccup away from missing a payment. We don't like that. So they usually build in what's called a debt coverage ratio, where they'll lend 80% or 85% if it's a strong business. So it's two pieces, right? So you're saying, okay, you have $100,000 to work with. We'll lend you enough debt to support, $80,000 a year, and you'll have a $20,000 a year buffer in case a piece of equipment blows out or a major customer leaves you. Who knows, right? That's that what if, or another virus comes around. So we have that kind of built-in buffer. Now, what is that cash flow worth? So the idea of the ability to support debt is great, but in the open market, there's really kind of three pieces, right, that you're identifying. So your alternative to buying a business is to go out and start from scratch, right? So that's really your ceiling, is to say, okay, if my alternative is to go down the street, rent a place, put a down payment on a building, buy all the furniture, fixtures, and equipment, buy the inventory, run for 6 months at a loss, build my customer list for 2 years, and then I'll have what you have now, right? So if all of those costs fully loaded into that calculation is, who knows, $500,000, and they're asking $700,000 for their existing business, it doesn't make sense, right? You can recreate it. It's going to take some hard work, but if you can put that money in and you've got the money anyway, that's the better alternative for you as a buyer. Now, then there's market price, right? The market price is saying, okay, I can buy your restaurant or your business, or I can go one town over and buy another restaurant or another business. And what are they asking for theirs? So it's the equivalence, right? The market price. And if the cash flow of the existing business supports a value greater than the assets themselves, then there's some goodwill there. Right? So that's another common misconception, is that the ability to support debt is one purchase price of goodwill, and then you have to buy the furniture, fixtures, and equipment on top of that. That's not the case. Right? So if the ability to support debt is $70,000 and the equipment's worth $50,000, then the goodwill is only the difference between those things. So the goodwill is the amount above and beyond the physical assets. Now, the floor value of a business is a seller just wanting to walk away, right? So if you're working in the business and the seller says, this is my last winter in Maine, I'm sick of it, I'm not going to work with a broker, I'm not going to market it, I don't care, I just need to turn my keys over and walk away, then you're just buying the physical assets, right? You're buying the furniture, fixtures, equipment, whatever inventory is on hand, they turn the keys over. So there's really kind of three values that we're looking at. The market price is the most pertinent. But one thing that I really want to reiterate to you as a buyer, right, is that what a business could be is what you're buying, right? You're looking at this and you're saying, this is my opportunity because it's missing this piece, and I bring that piece to the table. Right? This business is great, but it doesn't have a primary salesperson, and I have 20 years of sales experience. So I can take this business to the next level. Or you're looking at it, I'm excellent operationally, and this business has struggled without a primary operator for the last 5 years. So I can take it to the next level. But you're not paying for that, right? You're paying for what it is. You're buying what it could be. Right? If you overpay for something, then, however long it takes you to get there, you're losing money, right? So one thing this is the same graph we've already looked at, that historic seller's discretionary earnings. You've got that ability to support debt. More or less what the down payment expectation is going to be. You can work with the lender to figure out a reasonable interest rate and term length. That gives you a supportable purchase price. Now, if the seller is coming to you and saying, okay, the actual purchase price is above and beyond what it can support, you might be okay with that. You might say, what I'm bringing to the table is strong enough to get it there, right? But it's going to take 6 months, or it's going to take a year. And until then, the debt is above and the monthly mortgage payments on your debt can't be supported by the business. So you're going to have to be paying out of your salary to cover that piece. It burdens the business. And then the question becomes, how quickly can you build the SDE to a point where it can support the business and your salary? How long does it take to get there? And what are the risks, right? Is it guaranteed? Is it a slam dunk? If it takes 6 months instead of 3 months, where does that extra cash come from? Do you have a reserve in your personal bank account that you can bring to the table? That's up to you. Right? I'm not here to tell you one way or another, but be aware of the debt you're creating. And if you over leverage the existing business, you're going to be working day and night and taking less of a salary to make that work, which might be something that you're comfortable with. So then the question always comes up, right? Well, what about multiples? Right. So my accountant told me it's 3 times gross income. Okay, well, what does that mean? Right. So it's a suspect method at best. There are rules of thumb out there, and I don't want to knock them. I think it's a great place to start negotiation. It's a great place to kind of understand generally what you're talking about. But different multiples apply in different ways. So anytime you're buying yourself a job, right? You're in the business already and you're buying a job, or you're looking to buy out an existing owner and you're going to work in the job. Don't use a top line multiple. Right? And the reason for that is a top line multiple, a gross sales multiple, is really only applicable when you're talking about buying a book of business. Right? So if you're an accounting practice and you're buying out another accounting practice, you're just buying the market share. If you're a medical practice or an attorney or anybody buying a market share, then you might consider that kind of top line gross income multiple. But if you're buying an existing job, right, your insurance is going to look very similar. Your payroll is going to look very similar. All of your costs are going to be more or less the same. So the only applicable number is that bottom line, right? Is that SDE, that cash flow available to you. If they're doing $1 million in sales, but they're not generating any income for themselves, that's not really worth a top line multiple, right? Because the systems in place aren't generating any cash. There's no benefit to buying it as it is. You're just buying furniture, fixtures, and equipment. So why use a top line multiple? A bottom line multiple might be applicable, but again, the difference between that SDE and EBITDA is substantial, right? It's a whole salary, it's some other benefits. Sometimes a multiple means EBITDA, sometimes it means SDE. And those could be very dramatically different numbers. So be aware of what the multiple is implying. And then the last thing is, it's a rule of thumb, right? It has no indication of what kind of inventory is included in that transaction. Is inventory included or not in the multiple? If you're buying a retail store and there's $1.5 million in inventory on the shelves, is a multiple really the way to go, or is it more of a discussion of how that inventory is appropriately priced? Vendor relationships, how long have the employees been in place? All of these things matter, and they differ from business to business. And a rule of thumb multiple has no reflection of that value. So if you're just talking about a rule of thumb, you don't know how old the equipment is. You don't know how often it's been replaced. You don't know if, their primary salesperson just quit, and what you're buying is an incomplete org chart, right? So there's a lot that goes into that. Can you use it as a good place to start? Sure. But again, it's a start. So structuring the deal. I want to talk a little bit about this because it's a lot more convoluted, right, than just buying a building or buying a house, right? So commercial lenders typically are very comfortable with tangible things because in their mind, they're thinking, okay, if this doesn't work out, I can take those tangible things and I can resell them and I'll be fine. I don't really, not giving too much thought about how it impacts you, but as a lender, I have to protect myself, right? So they're looking at the real estate, the furniture, fixtures, and equipment, the inventory, and then they're applying that loan to value ratio, the buffer, against it, right? So if they're looking at real estate and the real estate appraises at $200,000, they're not going to say, here's $200,000, because in their mind, they're thinking, okay, if I have to take this back from you and I have to pay a broker to 5% to go out and sell it as commission or whatever, and I have to winterize it because it takes 6 months to sell, I'll lend you 90% of that value. Furniture, fixtures, and equipment, the same thing, right? I'm not going to give you a dollar for dollar amount of the value. I have to pay an auctioneer to go out and sell that. And I may make 60 cents on the dollar. So that's what I'll give you. So the less they're able to resell that, the more equity they're expecting from you. And those physical assets are kind of the cap, right, of what they're willing to lend. Now, what if the seller wants a higher price than the collateral supports? So, going back to this, what if this supportable purchase price or the actual purchase price, either one, the cash flow is there, but the assets aren't, right? So the business looks good, but it doesn't have the tangible assets to offset it. There are other options, right? So you might have some personal assets that you're willing to leverage up. Second mortgage on a home is very common for a buyer. A seller might be asked to hold some paper, right? So a seller might say, okay, I'm going to have a second note behind the lender, and the debt, the total amount of debt is covered, right, by the cash flow of the business, but part of it is a commercial lender in first position, and part of it is the seller in a second position. And then you get fun, right? You can get some creative solutions, like you can have a consulting agreement with the seller where you pay them X amount at close, and then you keep them on staff, and you call them monthly, or they check in, or they're available to you for a period of time, and you pay them out of the business for that. Or you have a flexible purchase price with benchmarks where you say, if I hit this benchmark, I'll give you some extra cash at the end of the year. Or if, or if it's not there, if what you're promising me, that you're hiding isn't actually hiding, it just doesn't exist in the first place, maybe you don't get paid, right? So you can tie those benchmarks, you can have some ongoing agreement with the seller outside of what the lender, the primary commercial lender, is willing to lend. You know, those other options, once you start getting creative, you know, that's where, you know, a good broker and a good, you know, financial analyst and a great attorney really come into play, because, you know, good attorneys make good contracts, right? You want that in writing. You want to know, what if something happens, what happened? Like, you know, the more clearly everything is stated and all of the possibilities are kind of thought about in advance and addressed, the easier it is to negotiate, you know, later on down the line. If 2 years out something happens, you just look at the contract and you say, okay, this is how we execute on this. So, you know, if you're entering into an agreement with a seller that exists after the close, right, after you buy and the transfer of assets takes place, you know, that good contracts make good partners, right? And they're a partner up until the point where they get paid off in full, or the contract is terminated. They will be there in some fashion. So if you're able to identify that in advance, that's a perfect way to structure the deal. But make sure you're understanding their responsibilities, their ability to have oversight, their input. You know, the last thing you want maybe is 6 months down the line, the seller looking over your shoulder and saying, I would really like to do it that way. You should do it this way. You know, it's my business now. So just make sure that's part of the contract, is identifying what responsibilities they have and where that line is. So one thing I did want to touch on, right, is a lot of the time you're talking about a sale, right? You're saying, I'm buying the business. There's actually two types of purchases that can occur, right? So there's a stock sale and an asset sale. It's important to understand the distinction. So 99% of transactions in the state of Maine are asset sales, right? And an asset sale is you're buying the existing assets of the business in a predetermined list. And an asset can be tangible or intangible, right? So you can say, I want all of these pieces of equipment, and I want, you know, the website, and I want the social media accounts, and I want the phone number, and I want historical financial information and customer list. So all of, you know, the latter part of that would be considered intangible, but they're still assets and you can still buy them. And the key here is that you are buying only the listed assets, and you're buying them as a new company, right? So that is where your balance sheet is created on day one as part of that kind of the purchase price of the assets, and the asset list being what you're purchasing. And the distinction there is a stock sale, you're also buying the liabilities. So sometimes people say, oh, it's easier to you're just buying my stock, 100% of my stock, and you're going to become owner. And that works, you know, it can work because maybe there's some outstanding accounts receivable and accounts payable and some work in progress, and it's just kind of this ongoing, and all you're doing is stepping in as owner of the company and you're running it. Now, where it doesn't work is if you acquire some liabilities that you're not fully aware of. So if there's a credit card in the company name for $25,000 and you didn't realize that, you own the company, right? That's your credit card now. The second that transaction takes place, you are responsible for those existing liabilities. So in some ways, it's easier to kind of understand because there's not all of those little individual transactions that have to take place. It's just you step in as owner. But in other ways, the due diligence has to be a little clearer, because then you're saying, okay, what are the liabilities that I'm taking on here? Are there any outstanding debts that you that you don't show on the books because you figured you were never going to pay them, but hey, all of a sudden there's a lawsuit and I didn't realize it, right? So just be aware of it, right? And part of that asset sale, which is, again, is far more common, is identifying those kind of other considerations. So who keeps the accounts receivable? Right? So if you're buying a construction company and you're stepping in and there's $20,000 of work that's been billed but not collected, is it the seller's responsibility to go out and collect that? Do they get to keep it? Or can you go out and collect it? And is that potentially $20,000 that you get to keep for yourself? Same thing with accounts payable, right? You don't want to step in as an owner and and have all of these outstanding debts not get paid by the old company, right? Because those are vendors that you want to work with. Right? That's a relationship that you want to maintain. So do you require that as part of the purchase, 100% of the vendor debt gets settled on the day of close? That's fairly common. Are there some, agreements that can be made along the way? Absolutely. But identifying it is first and foremost, right? So the due diligence, the negotiation part of the purchase and sale is saying, okay, who's responsible for paying what, right? How does this get settled so that I have vendors that are happy with me going forward? Work in progress, same thing, right? If they've done part of a job and you're stepping in and running that job from then on, who keeps the down payment? Who keeps the inventory? How does that get settled? How is inventory even priced, right? Do you walk through the day before and, do a final accounting of all of the inventory on the shelves? If you walk through it when you make your offer and there's, every shelf is full, and then on the day of close, you go in and everything's been emptied out and sold off, that could be an issue, right? So that is all part of this discussion, which is fine, right? And that's the complicated part, but it's important to identify and set the table. So I'll dive into the next section, keeping an eye on time here. But so when you're going through that due diligence and you're identifying the business that you want to buy, I've listed some things here that you should kind of identify, right? Is the current owner replaceable? Right? If they're selling you an operating company, but they're the primary salesperson and they've handled every major account for the last 20 years, and everybody only knows the business because they know the current owner, how transferable is that? Right? Transferable assets are purchasable assets. Same thing with standard operating procedures, policies, systems in place. If everything's just up here with the seller, what are you buying? How transferable is that? Maybe you buy that, maybe you pay for it as an employee contract and you say you have to remain on staff 40 hours a week for the next 3 years to get your purchase, right? Because what I'm buying is your knowledge, and I need that knowledge. And if you disappear down to Florida on the day of close, that all that knowledge goes with you. So identifying what they've put in place to step out and how easy it is for you to step in is really important. What contracts can be assigned, right? This is a big one. Do they have vendor contracts, customer contracts, real estate leases, employee contracts? How easy is it for those to be transferred or renegotiated? Right? If you're buying a business based on 2 major customer contracts and neither one of them survive the close, what are you buying? Again, good contracts make good partners. We've kind of talked about that. Clear lanes of responsibility, clear exit strategies if something goes wrong, really identify, okay, if this happens, then this will happen. Right? If the business isn't what it's worth, then you get paid less. If I do something, then you don't have the right to tell me not to do it or to do something different. Right? So, and then, really identifying, is this business right for you as a buyer? Is this the weaknesses, the historic weaknesses of the business? Do those align with something that you bring to the table? I really like the idea of that day one equity. You're saying, okay, I know as long as I do what I do best, I can step in and make this a better business. That's a great deal for you, right? Because you already know that your strengths align with the weakness. You don't want to buy something where your strength is already replicated, right? Where you're a salesperson and they have a great salesperson. Okay, now you have 2 salespeople. That's good, but would it be better to go out and find a similar business where they don't have a salesperson and that's what they're really lacking? And you can step in and say, here's the major customer accounts that I'm going to go after. I'm going to really grow this thing. And then kind of identifying some of the other things. Talk to the vendors, right? Talk to the customers, talk to the employees. If there's a lot of complaints or red flags along the way, don't buy it, right? I also did some work with turnaround management and troubled asset and liquidation. And often I'd have people who had bought businesses come in who had either over leveraged or ignored red flags, right? So they were kicking themselves because they said, I thought I could grow this business quickly enough to cover the debt, and I just couldn't, right? So that kind of over optimism is a red flag. And then the second thing was saying, geez, the customers were complaining and the vendors said they had bad relationships, and average employee turnover was every 6 months they'd have to hire someone new. And I thought I'd step in and I'd fix it all. But it just wasn't a good opportunity, right? So they spent their whole time trying to repair the damage that had already been done rather than growing and moving forward. So don't be afraid to step away if you see those red flags. And then the other thing you can start doing right now is really build your team. Right? So this is it's a long process. As I've kind of indicated, there's a lot of negotiation. There's a lot more gray area than just buying real estate or equipment. Surrounding yourself with people who have done it before, who understand it, and who know the questions to ask is so critical, right? So a good attorney is worth their weight in gold. Right? And I know some of them charge an arm and a leg, but being able to have that contract in place and do that due diligence is critical. An accountant, same thing. Having someone who can look at the financials and say, okay, here are some red flags, here are some questions we can ask. That's fine, right? Not all questions are red flags. Sometimes it's an easy answer, but just that understanding, the ability to kind of analyze and crunch numbers and look through it is so critical. I love financials. That's like, I won't get too far into that, but that's, you can tell so much about a business with the right perspective and looking at the financials. Most common timeline is something like this, right? So you meet with the seller and you confirm their interest, right? If they're not interested in selling, it's not going to work, right? So you say, okay, I might be interested in buying your business. Would you have interest in that? And sometimes they say yes. And if they say yes, usually they want a confidentiality agreement signed, right? They don't want to just open their books to a stranger. So you work with an attorney, you get a confidentiality agreement signed, and then you put together a letter of intent outlining terms, usually kind of a purchase price, a timeline, financial structure proposed. You make sure that they're interested, that interest extends to a reasonable purchase price and timeline. So if they say, yeah, I'm interested in selling in 10 years for $20 million, and you're like, oh, that doesn't really help me, then, the conversation ends. Right? But if you come to a reasonable purchase price that you agree to and they agree to and you're comfortable, then you put together a purchase and sale agreement. Right? And the purchase and sale agreement is the contract. So when something's under contract, that's what they're talking about. It's signed by both parties and it really outlines kind of the terms through the close. Right? Now there's two major periods in that purchase and sale from the day the purchase and sale is signed until the day of close. And the two terms are due diligence period, right, which is a period of time in which you can pop the hood and have a look. Right? You do an inventory assessment. You look at all of the equipment. You have employee interviews. You look at the historic financials and tie it out internal against tax returns, and you contact vendors and customers, and all of what you want to do should be listed in the purchase and sale agreement, right? Because some sellers will say, I don't want you talking to my employees until you've identified a timeline and gotten financing. Or they say, I don't want you bothering my vendors until a week before close. Right? So you can structure that timeline in a way that works for both of you. But part of that due diligence is saying, okay, when can I do what? And what is reasonable for me to ask for? And I do include a due diligence list, I think, on the next slide. So I'll cover some of that a little bit more. And then the second piece that happens in this time period is a financing contingency. Right? So a financing contingency usually gives you, as a buyer, a chance to pull the plug if you can't find the money. Right? So usually you have a proposal in place for the financing where you say, okay, I want to find financing for less than 7% interest of 50% of the purchase price, and I want the seller to hold the note for 40% of the purchase price at the same interest rate and the same term length, and I will bring to the table 10% in equity. Right? So by the time the purchase and sale agreement is signed, those kind of rough terms are identified and agreed to. So if you're asking for a seller note, the seller is aware of that going into the purchase and sale agreement. And you have something you can take to a bank, most important. Right? So if you're looking for a piece of this to be financed commercially, you have a purchase and sale agreement saying, here's what I'm buying, here's the asset list, here's what I'm paying for it, here's how I'm paying for it. And you can take all of that to a lender and say, is this reasonable? And the lender can give you a letter of commitment within a time frame, and you will have money at close. And if the lender says, this is not reasonable, I'm not going to do this, then you have the ability to back out of the agreement, right? Same thing with the due diligence, right? Both of those are contingencies because they give you a timeline with which to identify potential flaws. And if they are identified in that time frame, you can leave without consequence. You can get your earnest money back and walk away. So making sure that those two pieces are part of your purchase and sale agreement and understanding what you can do when and what you can ask for and who is responsible for what in that time frame is so critical, right? Because that gives you the chance to say, I didn't realize this, or man, this equipment's a lot older than I thought, or your organizational chart isn't what you presented to me and I have to go out and hire these people and I'm not comfortable with that. I'm going to walk away. If you get through both of those time periods and you're still satisfied, then you get to the day of close, right? And the day of close is a specific point in time where the physical assets identified, if it's an asset sale, get transferred, or 100% of the stock gets transferred if it's a stock sale. Then there are some things that survive the close. And by survive the close, I mean exist beyond that day, right? So the purchase and sale is terminated, is closed on the day of close when the cash transaction takes place, right? So there's a transfer of deeds or whatever is being transferred gets transferred, right? That happens. Then something survive. So if you have an employee agreement or consulting agreement with the seller, that survives. And you want to have that written up for the day of close, right? A non-compete, same thing. You want that written up and signed on the day of close, and that survives. So part of your agreement is you can't go out and start a competing business within 30 miles. You want that signed before you close. Otherwise, they can go out and start a competing business with the money you just gave them to buy their business. Seller note, you'll want that formalized. AR collection, AP collection, inventory identification, all of those things survive the close if there's something built in. So if it's their responsibility to pay the vendors, the existing debt on the day of close, you want to make sure that survives so that you can hold them accountable to do that. And then just some last, I threw some things together for common due diligence items that I've seen most commonly asked for. At least 3 years of tax returns, very common. Detailed equipment list. This is important. The details are critical here because you're kind of identifying how old is this equipment. If you're buying a construction company or an automotive company and the purchase price is $100,000, but you have to replace $80,000 in equipment on day 2, then in your mind, you should be thinking, this is a $180,000 purchase because I have to replace all of this equipment in order for that cash flow to continually be generated. So maybe the purchase is only $20,000 and you have to build in $80,000 in new equipment. So, just something to think about is how old is that equipment? How often does it have to be replaced? What's the mileage? Make, model, are these good? Is this good equipment or bad equipment? Dig into that. Organizational charts, longevity is a big part of this. I've seen deals structured where the employees actually get paid a bonus part of the sale price after a year, right? So, the seller really wanted to ensure that his employees had a job for a period of time. So he said, I'm going to take a haircut on the sale price, but I want my guys to get a bonus a year out. And from the buyer's perspective, it was great because he had a team in place, right? Guaranteed, or as close to guaranteed as you can get without an actual contract. He's dangling this carrot out in front of them saying, stay on board with me through this transition, you get a bonus on the flip side. Their responsibilities, make sure everything's covered. Any contracts, employee contracts, make sure you understand those. Sales by customer reports are very helpful. You can kind of see, okay, Is all of their business from one customer? And if so, how secure is that customer? Is that a red flag? Is a lot of their business repeat, or do they have to go out and solicit new business every year? Is that good? Is that bad? Proposed schedule of inventory, AR, and AP at time of close. So accounts receivable is what people owe you, AR. AP is what you owe to people, right? So your vendors primarily. Who handles that? Right? Just identifying it, right? It can go either way. It could be the sellers, it could be yours. There could be a split between the two. How is that handled? Any contracts, right? Equipment leases, real estate leases, what's assignable? We've kind of talked about that. Intellectual property is one that, a lot of people kind of think about peripherally until the day of close. Passwords, right? Who has the passwords to the social media accounts? When was the last time the LinkedIn was updated? Who has the keys to the building? Who has the company credit cards that are, do the drivers all have credit cards that they're walking out with? Who has the payment software? Can that be transferred? Internal financial documents, I think, are rather important. You can compare to the tax returns, make sure there's nothing too egregious. There's no large differences between them. Licenses and permits, can you operate on day one of the purchase? Do you have your licensing and permitting in place, or can those licenses be transferred? And then there's some industry specific stuff, right? So always ask your attorney, your broker, your accountant, what you're missing, right? What you should be asking for that might not be listed. So I think 30 seconds over my time, but tried to keep it. I can stay on as long as possible. I'd love to answer any specific questions you might have. And like I said, at the beginning, we're a free service, right? I transferred to the SBDC about 2 years ago after having my first kid and before having my second, as part of just kind of a quality of life thing. I love being able to provide service and help without charging for it. So, we're here for you, the SBDC as a whole, myself, whatever questions you have. If we don't know the answers, we know who does, and we can either help you find them or point you in the right direction. Talked a lot. If you have any questions, please reach out. And I'll just stay on for a couple extra minutes.
Thank you very much. Thank you very much for all your information. This is very well presented.
Thank you. Yeah, it's what we're here for. And
yeah, really, really well presented. I really appreciated all the information. Have a very good day.
Thanks, Anne-Marie. And the recording and slideshow will go to you. So if you missed any of it or you want to double check it, you'll get that as well.
No, really very thorough. Gave me a lot of pause for some of the more detailed items that I probably would have overlooked. So again, thank you and have a very good day.
My pleasure. You too.
Raynor, Dawn Smith here. I have a question. What's the downside of purchasing a franchise? How would you find the background info?
It's a good question. I haven't actually done that many franchises. I would say the downside is, they often come with substantial material financial commitments, right? So you do have to pay a franchise fee every year.
Every year?
Not typically every year, and at the start, a larger one. Now, that's not necessarily a downside. It is a downside, but it's often offset with advertising and marketing or some assistance on the back end. So it goes hand in hand with also some of the benefits of buying a franchise. There's a group called FranFit, FranFit, that helps with franchise acquisition. So I'd reach out to them and see, they represent quite a few franchises and help with that kind of identification of appropriate franchises, as well as location and startup.
Okay. All right. Thanks.
Yeah, of course.
Is there a formula for finding values for equipment or tools when purchasing a business?
It depends. I wish I had that straight answer for you. I mean, like, so restaurant equipment is notorious for, you know, losing 70% of its value on day two. I would, so Keenan and Keenan Auction do
Keenan
a
and
very
Keenan.
good job.
Yep.
So they're one group, they do like desktop appraisals, which basically you give them an equipment list with, you know, age, name, and type, and they
Yeah.
can just put together a quick kind of thumbnail cost approach for a fee. So, you know, I might reach out to them and ask. Rule of thumb, it really depends on how old it is, what type of equipment, the industry. I mean, there's some construction equipment that lasts, you know, 30, 40 years. Restaurant equipment's notorious just because, you know, it's got to be replaced every couple years. So it really depends.
Okay, thank you so much. Great, great presentation.
Someone asked in the chat, what's the best source for finding Maine businesses for sale? There's a number of resources. Biz Buy Sell is probably the most common. There's also NECPE, New England Commercial Property Exchange, has a business section to their website. Craigslist, you know, for sale by owners. People often turn to Craigslist. And then there's, you know, different brokerages as well. So Magnus and Balfour is the largest listing business brokerage. There's Maine Business Brokers. There's a couple others as well. For just simple online search, though, I'd probably start with Biz Buy Sell. That's kind of the most common. Is earnest money involved in commercial sale, much like a real estate transaction? Yes. Yeah. You know, particularly with businesses, because there's the due diligence is so intensive, right? So it's an inspection on a building is fairly simple and straightforward, but a seller for a business has a lot more emotional involvement, you'll find, in the sale. And having someone go through and critique everything, which you should do, right? That's part of the due diligence process, does have an emotional cost. And so for you to demonstrate that you're willing to do that and put them through that, there is usually earnest money involved. And again, you know, identifying a financial contingency and a due diligence contingency so you can protect that earnest money and get it back is critical. So make sure that's part of your purchase and sale agreement. Earnest figures entirely arbitrary. There's not really a rule of thumb. Usually it's a couple % of the purchase price is, you know, a starting point. Again, you want to balance, you know, not putting too much on the table where it gets really contested and heated if you decide to walk away, while also, you know, not insulting them. So you don't want to kick them a couple $100s and call that earnest money, but nor do you want to put $100,000 on the table. So somewhere in between. Big window. All right, well, if there are no other questions, our contact information is on here. I certainly appreciate you taking the time again your afternoon. Keep in touch, reach out if you need anything.